The U.S. Federal Reserve, often simply called the Fed, is one of the most powerful and least understood institutions in the world. It is not a government agency, nor is it a private bank. It is a hybrid entity established in 1913, after a series of devastating financial panics proved the U.S. needed a central authority to stabilize its banking system. The Fed's primary mission is known as the dual mandate: to keep prices stable, which means managing inflation, and to maximize employment. Essentially, they are the economic referees, constantly trying to balance the volatile forces of growth and stability. The structure of the Federal Reserve is intentionally decentralized, consisting of a board of governors in Washington, D.C., and 12 regional reserve banks that cover the country. This structure is meant to ensure that monetary policy accounts for the diverse economic conditions across the United States. How does the Fed achieve this balance? Their most famous tool is setting the federal funds rate, which is the interest rate banks charge each other for overnight lending. When the Fed raises this rate, it ripples through the entire economy, making it more expensive to borrow for homes, cars, and business expansion. Lowering the rate does the opposite, encouraging spending and investment. This power was put to the ultimate test in the 2008 financial crisis. As the housing market collapsed and global financial institutions teetered on the brink, the Fed acted decisively, dropping the federal funds rate to near zero and introducing a radical new policy called quantitative easing. This involved injecting trillions of dollars directly into the financial system by buying up bonds and other assets. The goal was to unlock frozen credit markets and prevent a complete economic collapse. This was an unprecedented intervention, but it established the Fed as the ultimate lender of last resort. More recently, during the COVID-19 pandemic, the Fed again stepped in to prevent a market freefall, establishing new emergency lending facilities and continuing its bond-buying program. The actions taken during these crises were massive, moving far beyond traditional interest rate adjustments to shore up critical parts of the financial infrastructure, from corporate bonds to municipal finance. The enormous financial support stabilized the economy but also contributed to a new problem: surging inflation. Fueled by supply chain issues and pent-up demand, prices rose rapidly. The Fed had to pivot, moving away from crisis support and beginning the most aggressive series of interest rate hikes in decades to cool down the overheated economy. This is the constant challenge of the Fed, a tightrope walk between stimulating growth and controlling prices. Every decision they make directly impacts the cost of living, the number of jobs available, and the stability of the global financial system. Whether you are buying a house, opening a savings account, or starting a business, the Fed is silently guiding the economic currents of your life.